Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at the market site in Times Square, we have Jay Gragnani. He's the Head of Research and Client Engagement over at Nasdaq Dorsey Wright. We're going to take a look at ETF model portfolios and their rotation in regards to sector rotation. It's great to have you with us.
Great
as always, Jay. Now, let's take a look at the May pullback that we had. Nothing too crazy, sort of a blip on the radar, but from a historical perspective, what's that telling you?
Sure. The May pullback, I think in many ways, was a bit unnerving for investors, but it wasn't anything that was outside of the realm of normal market pullbacks. When you look historically, if you go back in the S&P 500, all the way back to its origination, there's been about 300 similar type of pullbacks. And what I mean by similar pullbacks is a 5% pullback from the recent peak. So on average, if you do the math, that's about 3 per year. On average, any given year, the market has historically pulled back by about 5%. So from a historical perspective, it's not anything that's crazy outside the realm of possibilities. Obviously, since then, we've recovered all of that pullback as the market's rallied about 6% off its lows. But when you go back and you look historically over the past 10 years, and you see every single year, except one this decade, every single year, the market has seen a 5% pullback. That one year that we didn't see it was 2017. 2017 was one of those years where volatility was basically non-existent. But what we've seen recently in 2018, you saw an above average number. You saw about 5 in 2018, 5% pullbacks, and 3 of those came in the back half or the last 3 months of the year. So when we saw this 5% pullback happen, there was a lot of feeling left over from the fourth quarter of 2018 when you saw a lot of volatility, a lot of 5% pullbacks right in line with each other. So with that said, when we look at the markets today, we didn't see during that 5% pullback in the market, what we didn't see though is anything structurally change underneath the surface of the market. And what I mean by structurally change, long-term trends still generally remained intact. And sector leadership still generally remained intact as well, barring a few small adjustments.
All right, now let's take a look at the sector performance. We have the chart up here. Not really too much of a surprise to see, a little bit of rotation out of some of the growthier sectors and a little bit more into safer sectors, if you will.
Absolutely. You look at it, and I think the big trend really this year, and really for the past couple of years you see there, has been technology on the top of the leadership board. Technology is up about 24%, best performing broad sector so far if you look on a year-to-date basis. It was not immune to pullback in May, certainly, but it still remains the best performing sector so far this year. What's interesting is real estate. Real estate is the other sector that's up there that is up in excess of 20% over the course of the year. So those two sectors kind of leading the charge in terms of returns and performance on a year-to-date basis, perhaps for 2 very different reasons, right? You get the growthy technology names that are carrying that growth and technology leadership trend. Obviously, the real estate, very interest rate sensitive area. Interest rates have gone down quite a bit this year. But what's interesting when you look at all 11 of these broad sectors, I think there's a couple things to be paying attention to. Number one is 9 out of the 11 are actually up double digits this year. And so just from a macro market perspective, that's a generally healthy market environment when you get the vast majority of sectors that are up double digits this year. The one spot really this year and really for the past few years that has been tough and really struggled is the energy sector. Right. Energy is down there and has perpetually been down there over the course of the past few years. And so, really one of the things that we talk about is identifying leadership trends. Number one, knowing what sectors that we want to have exposure to, things like technology, things like real estate that have come on here recently, other things like even, financials and utilities to some extent. That's very, very important, but what's also important is understanding which sectors that we want to avoid or be underweighted in, and really for years that sector has been energy, that has been the laggard sector in the market.
Now, ETF model portfolios, that's a big part of what you do at Nasdaq Dorsey Wright. Are you seeing any changes within them that are similar or different than what you're seeing with sector performance?
Yeah, sector performance, over the past couple of years has been, pretty much relatively stable at the extremes, meaning technology has been, really the winner over the past couple of years. We've seen technology, have exposure inside of our ETF model portfolios for quite some time now. I mentioned energy. Energy has been a name that has been absent from exposure to the ETF sector model portfolios that we run. But what we have seen here this year has been pretty interesting is a rotation removing and in some cases just simply underweighting healthcare. A healthcare sector earlier in the year got a little bit volatile after moving into some portfolios at the end of last year. And so healthcare we've seen rotate out, and you can see that show up in the sector performance as healthcare has been one of those sectors that on a macro perspective has underperformed the broad equity market, but has also underperformed other sectors. So what has taken healthcare's place has been utilities. Going back, really into April, we saw some utilities rotate into exposure to some of these models. And again, a very interesting picture when you look at it, these sector models that hold, very traditional growth sectors like technology, more traditional value or dividend type of sectors like utilities, and they've both worked very, very well this year.
Now, within the ETF model portfolios, when you have a month like May where there was volatility with a down 5% month, as you had mentioned before, do they change their composition day to day, or is it reviewed monthly, or is it dependent on that portfolio?
Yeah, so I think that the answer there is really it's dependent on what happens in the market. And so typically a lot of our ETF model portfolios are evaluated every week, or maybe sometimes some are monthly, but a lot are more frequent than that. So we can monitor those positions throughout the course of the month to see if anything needs to change. But if you don't see any discernible changes or any signals that are generated as a result of the market movement, as everything more or less was kind of pulling back, a lot of that stuff in the month of May did not necessitate any changes. Some of the changes that we looked at earlier, the healthcare utilities switch, for instance, that happened earlier on back in April, prior to the market pullback or prior to heading in to the month of May, which, as we know, is the first month in the seasonally weak period in the market, the sell in May and go away idea. Certainly May didn't disappoint in that regard so far this year. But a lot of those model portfolios, while we don't necessarily have to make changes on a weekly or daily basis, we're reviewing and monitor those things on a very frequent basis.
I mean, you can certainly see why advisors are increasingly incorporating these into their businesses.
Absolutely.
It takes a lot of the guesswork out for them, and they can focus on their clients. So to wrap up here, headlines are really driving the market. What's your outlook going into the second half?
Yeah, the headlines certainly drive the market and drive a lot of investor decisions, for better or worse. And so if we can have some kind of system, some kind of rule set to look at and evaluate the markets in an objective fashion, as opposed to trying to listen to the headlines or read Twitter all day long, we really want to be objective in looking at, very specifically, we're looking at relative strength trends, seeing today that U.S. equities, as it has been for quite some time now, remains the #1 ranked asset class. Despite the volatility that we saw in the month of May, U.S. equities remains #1. You look at the markets, I mean, the indexes are, close to new highs, markets pulling back a bit today, but the markets are still certainly hitting or very, very close to new highs, not quite getting back to those highs. During that May pullback, though, what was interesting is you saw a number of very, very key support levels on things like the S&P 500 were held, and we've seen those charts, the S&P 500 specifically, return back to a near-term buy signal within the confines of a positive trend. And so, I think that's a healthy market environment when you just look across the board. The last thing that I'll mention is, speaking of the S&P 500, if you look at the S&P 500 stocks, so all 500 companies that make up that index, about 2/3 of those stocks are in positive trends today. When you have readings that high, you don't tend to see, major holes or major weakness within the market. Those are generally strong signs. Once you start getting that number below the 50% level, that's where we tend to see more broad weakness. But right now, when you get a market where more than 2/3 of the stocks are in positive trends, that's a generally healthy market environment.
All right, JJ, as always, thanks for joining us up here in
Thank
New
you.
York. And thanks for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at